on. We have Venkatesh Balasubramaniam now joining us, Managing Director and Co-Head of Research at 𝐲𝐻𝐻 Financial Institutional Equities. Venki joins us from the sidelines of the 𝐲𝐻 conference, India conference, which is kicking off. Venki, good morning. Great to have you with us here. Thank you for your time. You know, those who, for the uninitiated, Venkatesh, of course, was the veteran capital goods analyst for a very long time at a top sort of institutional broker. And of course, he's taken on his roles and responsibilities at 𝐲𝐻 Financial fairly recently. Venki, welcome again. Just a quick word on your sort of understanding of you know, where the market is headed from here, and what are the two or three sort of things which are at the heart of answering that question, the dominating drivers in that sense. Venki, go on.
Okay. Now, look at it this way. I mean, I think a lot of things started unraveling somewhere around, somewhere towards the end of September, when the Chinese government started giving a stimulus package. Now, when the Chinese stimulus package came through, most foreign institutional investors realized the Chinese markets are trading at a 1-year forward PE of 8 or 9 times. Meanwhile, India, through July to September, was trading at almost a 1-year forward PE of 21 to 22 times. Now, that is almost above one standard deviations from the mean. So the call was, is there a case to move some amount of money to China? So we believe that in the month of September, at least towards the end, there has been a move of money. China saw FII inflows of almost $96 billion. Now, once that passed, we moved into October, the month of October, and earnings season, I think, started somewhere around October 5th or 6th. Now, what happened in the earnings season was results were mostly disappointing. When we did our analysis, we realized that almost 66% of the companies in our coverage have seen EPS cuts during the earnings season. Almost 45% of the companies have seen target price cuts. We've also observed that a very clear trend that small and mid-cap companies, we are seeing higher amount of EPS cuts than in large caps. And also we observed that in small and mid-caps, a greater than 10% EPS cut was quite common, which was not very common in the large caps. Now, that was most of October. In the month of October, we almost saw, $13.5 billion of FII outflows. Thankfully for you, DII inflows of almost 12.9 billion kind of counterbalanced the whole sell-off. And that is why in the month of October, you saw the broader Nifty correcting by only 6%, despite the fact that this was the largest single month outflow of FII money from India. Now, as we moved into November again, unfortunately, with Trump coming to power, it basically indicated to the market that the US dollar would be stronger. It also indicated that interest rates could be higher for longer. Now, we also believe that at that point in time, there is a possibility that FIIs might have taken a call. The US market looks very interesting. How about taking some money back? So what we have observed is the FII outflows have continued in the month of November so far. So this is where we are poised, and this is when we are trying to host our India conference. Now, the thought process is very simple, that valuations have corrected. Sell-side analyst estimates have also got cut. So valuations are slightly more reasonable. I wouldn't say India valuations are cheap. We are still trading at almost 20 times P 1 year forward, which is not cheap because the mean is somewhere close to 17 or 18 times. But this is a good time for investors to start once again analyzing their, whatever they have cherry-picked so far, and start analyzing them. And that is what we are facilitating in our conference, that people can come and meet some of these corporates in the conference. At some point in time, over the next month or so, we believe FII outflows will start coming down meaningfully. At least outflows will stop. I'm not sure when the inflows will start, but outflows will stop. So this is a good time to once again start looking at things. We also believe on the Indian economy side, corporate capex will start picking up in the second half. We also believe that rural demand has started picking up. So some of these positive factors are still there, and domestic SIP inflows will continue. So it is a very good time to start looking at companies, figuring out where are the pockets of ideas that you should be buying.
Okay, all right. Hi, Venkatesh. Good morning and good to see you in. This is Nigel on this side. Very, very valid points you're making on that
morning,
front
Nigel.
for investors to come and post this correction. Risk, I mean, it's far more favorable when you're buying 10% low on the index itself and stocks have corrected more. Talking about the domestic flows, we were talking about the mutual fund industry sitting on cash of roughly around 1.6, 1.5 lakh crore odd. Now, what's happened in the month of October, as you mentioned, the FIs were selling lock, stock and barrel. The domestic money was buying that. So we have seen a fair bit of deployment out there. In addition to that, we have IPOs where money was deployed as well. But we have the SIPs that continue to look quite strong. You have a ballpark number. What kind of liquidity is the mutual fund industry sitting on? Because we're banking on them. We are hoping the FI stop selling and we're banking on the domestic liquidity. So if you'll have a rough number.
See, look at it this way. Even if you assume whatever was the cash levels at the starting of October have got deployed over the month of October, on a monthly basis, you are at least having ₹500 billion of mutual fund inflows which are still coming in. Even in the month of October, what have you observed? We have observed almost 590 billion rupees of inflows into domestic mutual funds. Out of that, of course, roughly 70 odd billion is basically arbitrage flows. Even if you take them out, that's roughly 518 billion rupees of inflows. We believe these inflows can continue for the near future, especially given that 50% of that is basically SIP inflows at almost 253 billion. So we believe that there is enough and more money in India to support this sell-off. And at the end of the day, the sell-off has come down a little bit. At least it has started decelerating. At some point in time, it will also end. Maybe it will take a month more, but the deceleration will happen. And as people observe that third quarter is perhaps not as bad as the second quarter, obviously FI outflows will kind of stop.
Okay, all right. Just to summarize that, Venkatesh, hopefully the FI outflows slow down and you believe that domestic money is adequate. I think it's around 5% of the total industry size, and that's adequate to support the market, right?
Yes, precisely.
Got it. What would be the realistic assumption on earnings, though? I'm looking at the BSE 500 companies. The earnings growth for the first half was little south of 10%, I think around 9%. And for the year, still consensus is working with, I think, 16 to 17%. The government spending is there, yes, but the base as well is a little bit higher. Realistically, what should the earnings growth look like?
We usually look at earnings growth on the Nifty. And now, given that the quarter is largely over and most of consensus and our own analysts have cut numbers, our analysts predict that the Nifty growth for the current year is more like 6 or 7% odd. That is what we are expecting for the current year. So this year, on a relative basis, we have seen a deceleration. We are expecting a rebound the following year, which is FY26, where we are expecting almost 17 to 18% Nifty EPS growth.
All right. Interestingly, the domestic mutual funds, or MF holdings, if you look at it, they're overweight on pharmaceuticals, healthcare, capital goods, and consumer durables. Sectors which saw the highest FII outflows included the likes of BFSI, oil and gas, and FMCG. Whereas the sectors which saw a fair amount of inflows, or the only two sectors which saw inflows, were chemicals and metals. Would your sectoral position or call be similar to what the mutual fund industry is overweight on and what the FIIs are buying in terms of sectors right now as well? Or would you have a different outlook here?
Okay, see, on the long side, the sectors that we like are obviously one of the best sectors we like currently is metals and mining. And I'll kind of lay out the reasons for you. At this point in time, spreads are high. Why are the spreads high? Because input costs are lower. Especially coal prices are on the lower side. Now, with the China stimulus, we are expecting metal prices to go up more. Further, when Trump takes over presidency, normally he puts a lot of import tariffs. Now, that also leads to higher prices on the metal side. So, we believe that the next couple of years could be a very good time to own metals, and we would advise most investors to be overweight on metals. Now, what beyond metals? Now, if you look beyond metals, some of the sectors that we like at this point in time are basically IT, pharma, diagnostics. This is something which we really like. We also like the asset management industry. So ownership there could be good. Amongst the banking and financial space, we are a little partial towards PSU banks. Given that we are expecting interest rates will be higher over the next year and a half, once Trump comes through, we believe that NBFCs will not do that well given their fixed rate asset books. And between private sector banks and PSU banks, we have a slight preference for PSU banks because valuations look more reasonable. So these are some of the sectors where one can be overweight. Chemicals is one sector which you mentioned where there was FII inflows. Good time to start looking at this sector, but we would wait for another 6 to 9 months before we would advise people to start building positions. The reason there is maybe you will see another quarter or so of earnings cuts, so valuations become more reasonable there. But yes, Trump coming to power is very good for export-oriented sectors because we believe that Trump will definitely put higher tariffs on China vis-a-vis India. And what that does is if you have sectors like, say, chemicals or maybe even wires and cables or tiles or a few of the other sectors which are export, they would definitely benefit in this kind of a scenario. And obviously, what you are noticing now is FIIs are already positioning themselves for that. So that is why you have seen inflows in chemicals.
Very interesting calls out there, especially on the metals front and the PSU banks. Unlike a lot of the other conversations that we've been having with a lot of experts who do believe in private sector financials, but Prashant, interesting ones out there.
No, absolutely. And Venkatesh, thanks very much and hope this is the first of many conversations here on CNBC. Appreciate it. Well, that is the conversation from the sidelines of the 𝐤𝐸 Institutional Conference. We'll take a quick commercial break here.